With Trump as our next president, there's a lot of questions about what the next 4 years and beyond will look like. But in this video, we're going to focus on one specific question, and that is, how will Trump and the White House affect my Roth conversion decisions? As a certified financial planner, I often recommend Roth conversions to clients as a way to save money in taxes over your lifetime. But with tax bills always changing depending on who's in the White House, it's important to reassess and adjust the Roth conversion strategy as necessary. So in this video, we'll address that question as well as some other considerations to keep in mind with a second Trump term. Hey everybody, my name is Jake Skellhorn. If we haven't met yet, I'm a certified financial planner and the co-founder of Spark Wealth Advisors. This channel and my firm are both dedicated to giving you more confidence and clarity with your money. Keep in mind, as of the date of filming this video, Trump is president-elect. In other words, none of this is set in stone. But a lot of experts would agree that a lot of it is likely to become reality, given that Republicans now control the House and the Senate as well. So first and foremost, just a little bit of background on Trump's tax bill that was passed back in 2017, known as the Tax Cuts and Jobs Act. This tax bill made a ton of sweeping changes to the tax code, mainly federal income tax brackets and the standard deduction amounts. Because of the way that this bill was passed through Congress initially, most of its provisions were set to automatically expire at the end of 2025 and revert back to pre-2017 tax code. So now that the 2024 election results are in, and not only is Trump going to be president again, but the Republicans also control the House and the Senate, it seems highly likely that there will at least be some sort of extension to the Tax Cuts and Jobs Act, if not made permanent into law. So back to the question at hand, which is, what does this have to do with Roth conversions and how does it affect them? So for those that are not familiar, a Roth conversion is simply converting money from a pre-tax retirement account like a 401k or an IRA into an after-tax retirement account like a Roth IRA, with the intention of paying some taxes today if you're in a lower tax bracket than you expect to be in the future. Roth conversions can be especially beneficial to those who have large pre-tax balances in 401ks and IRAs, which lead to larger RMDs in your 70s, which ultimately could mean pushing income into higher tax brackets whether you need that money or not. So with the expectation that the Tax Cuts and Jobs Act was set to expire initially at the end of 2025, tax rates would revert back to pre-2017 levels, which would be higher than they currently are now. A lot of people were converting their pre-tax dollars to Roth in anticipation of this to lock in those lower tax rates today. So now that it seems like the current tax brackets will remain in effect for years to come, it may offer you more flexibility to spread out those Roth conversions over many more years, rather than trying to condense them into the next couple of years or so before the tax law sunsets. Beyond just the federal income tax brackets though, there are other considerations to keep in mind when making your Roth conversion decisions. The other main thing that the Tax Cuts and Jobs Act did was increase the standard deduction. So under our tax code, you have your gross income from your employment, businesses, and other investments. From that, you get to deduct the greater of your standard deduction, which is a flat dollar amount, or the total of your itemized deductions, which includes mortgage interest, state and local taxes, etc. With the increase of the standard deduction back in 2017 under the Tax Cuts and Jobs Act, the vast majority of Americans now take the standard deduction when they file taxes. And while Roth conversions can be assessed on a year-to-year basis, it often makes sense to try to look out into future years to project what your taxable income will be, whether you're retired or not, and make that decision based on what deductions you'll take, whether it be standard or itemized. So by keeping the standard deduction at current levels, it may make it easier for you to project out what your taxable income and tax bracket will be, rather than trying to add up what your itemized deductions might be, which typically will vary more from year to year. With that said, there are some talks about the state and local tax deduction cap being lifted from $10,000, which currently means that if you pay state and local taxes, you can deduct up to $10,000 of that money from your federal taxable income. So this may allow more tax filers in the future to itemize, depending on whether that gets lifted or not. Something else to keep in mind when deciding whether or not to do Roth conversions is IRMAA surcharges, which is essentially a Medicare surcharge when your income reaches a certain amount. While IRMAA surcharges were not changed or affected by the Tax Cuts and Jobs Act, it's something that you should still keep in mind when deciding whether or not you should do Roth conversions. Keep in mind that it's based off your modified adjusted gross income as of 2 years before. In other words, any Roth conversions that increase your modified adjusted gross income today could potentially create IRMAA surcharges 2 years into the future. Something else Trump has talked about through his campaign was eliminating taxes on Social Security. We'll have to just wait and see whether or not this becomes reality, but I think this would have to come with some sort of other funding solution for Social Security to prevent the trust from being depleted by the year 2033. I did do a separate video on this if you want to check that out after this one. With that said, if taxes are eliminated on Social Security, this could affect when you claim it, because a lot of people tend to delay Social Security while they're doing Roth conversions to prevent that Social Security from being taxed. For example, a common strategy is to retire at 62, do Roth conversions between 62 and 67 or 70, and then claim Social Security. But if Social Security isn't going to be taxed, then maybe it makes sense for you to claim earlier. Again, this is one of those things that we'll just have to wait and see, but something to keep in mind. There's also talks about eliminating income taxes completely and replacing them with tariffs. I think this is a little too far-fetched to actually pass through Congress. But if that were to happen, I can't see how that would also apply to pre-tax retirement accounts. It might apply to earned income, but not ordinary income, which is what withdrawals from retirement accounts are considered. Because ultimately at that point, everything would just be considered a Roth account and wouldn't affect your Roth conversion strategy at all. A couple risks to consider if the Tax Cuts and Jobs Act does become permanent, and that is that future administrations can always repeal or modify provisions of this tax bill, especially if the budget deficit widens and the government needs to find other sources of income to fill the gap, so to speak. Potential new source of revenue that the government could seek out would be to tax Roth withdrawals. A lot of people out there are concerned with that. I'm very hopeful that this will never become the case, but something we'll just have to keep an eye out for in the future. So just to recap, with Trump in the Oval Office for a second term, it's likely that the Tax Cuts and Jobs Act will be extended, which could give you some more flexibility for doing Roth conversions over the next few years. When making your plan for Roth conversions, keep in mind that the standard deduction is likely to remain the same, but the state and local tax deduction cap could be lifted, which may make it more beneficial for you to itemize your deductions instead. Also keep in mind that IRMAA surcharges are an effect of Roth conversions, which can be seen as an additional tax. So make sure that you're consulting a professional familiar with your situation to see whether or not that makes sense for you. As I mentioned in the beginning of this video, this is all speculation as of right now. Nothing is set in stone. So don't take anything in this video and act on it as personalized financial advice. If you found it informative or helpful at all, consider subscribing to the channel to stay up to date on any future videos I make on this topic. And as always, visit our website at sparkwealthadvisors.com to learn more about what we do. Thanks for joining, and we'll see you in the next video.